Good afternoon, everybody. Thanks for attending. We have a sellout crowd. I'm sorry for the time change. I had to be in court this morning, but we're back. So today's webinar is expert-packed. I'm actually excited about it because we have a bunch of guys that are going to teach me as well as you about valuing your integration side of the business, your non-RMR part of the business. I must confess that having been very involved in legal areas of the alarm industry for so many years, my experience really is almost limited to RMR valuation, which traditionally has been the way to value alarm companies. But with new technology and evolving business practices in this industry, plenty of alarm companies that were traditional RMR model-based are now concerned about selling their integration side of the business, which is the non-RMR end of the business. So we're going to start with an industry icon, a true expert, an accountant by trade, a practicing, I guess, broker once in a while who does deals. I turn to Mitch Reitman whenever I need tax advice, and he's always very happy to give it. And you could put Mitch in one of my staff here. Mitch, I hope that you're on and ready to roll.
I am, Ken.
Okay, good. So I'm going to, oh, Mitch, just 1 second. I guess I forgot to go through my own slides. Let's see. What slides do I have for you? Oh, yeah, my contract order form. There we go. Well, a few more guys sign on. We'll just leave that up for a second. And I suppose that everyone signs on to my webinars here expecting to get some kind of discount, and we may end up discounting something. Here's our page for what's my alarm company worth, and really it's RMR valuation that I do through that website. And if you want some complex integration side, we'll have to bring in someone from the panel today to do it. If we have time, we're going to talk about the sales affiliate agreement that we prepared. That's for an independent contractor, and we may offer a discount on that and a discount on the business associate agreement that you're going to need with it. But having said that, how about we tap into Mitch Reitman's brain on this topic. Mitch, it's all yours, and you have your first slide up with your name.
Great, thank you, Ken. And I guess let's see what's on the next slide. And I guess the next one. And I'm Mitch Reitman with SIC Consulting. And what we do is tax preparation or representation and financial consulting with the security and systems integration industry. We only work for alarm companies and security companies. We have about 350 clients, and I've been in the business nearly 20 years. We understand what you do, and we understand the uniqueness of your business. We also work on transactional work, doing due diligence and brokerage services. If we can look at the next slide, we'll talk a little bit about valuation. Valuation is generally the fair market value of a company or its assets. And there is no true law about valuation, but what all valuation comes back to is a revenue ruling that was issued in 1959 by the tax court, by the IRS, that said fair market value is defined as the price at which a property would change hands between a hypothetical willing buyer and a hypothetical willing seller, both being adequately informed of the relevant facts and neither being under any compulsion to buy or sell. That sounds very simple, and it's just one paragraph, but that ruling itself is about 40 pages long, and then there are literally hundreds of thousands of pages of interpretation that has happened since then. So we'll look at the next slide. Why would you want to get a valuation? One reason is for estate planning or for tax purposes. If you're going to convert from a C Corp to an S Corp, you need to figure out what the corporation is worth the day you convert. One reason we unfortunately do a lot of our valuations for is for divorces, to try to figure out what the value of the property is. We get involved in owner disputes where owners can't figure out what their company's worth. We do valuations for damages and litigation where somebody is saying that their company's value has been diminished and they want to figure out what that was. We also do valuations for the probate court and for inheritance, and also for people preparing to buy or sell. So look at the next slide. What rules are there that apply to valuations? Well, actually, there are no rules. There's no law out there as far as statutory law, and you don't need to be licensed to do a valuation. It's not like being an attorney or being a CPA or even being an alarm company. Anybody that wants to can go out and do a valuation. But even though there are no statutory regulations, there are case law coming from the divorce and tax courts that's very important to follow if you think a valuation may end up in court. There are also professional standards. For example, our firm uses the ASCPA business valuation standards, and they're accepted practices. So let's look at the next slide. And that will talk about valuation approaches. There are three general accepted approaches that you can use. One is the market approach, one is the income approach, and one is the asset approach. So what is the market approach? The next slide, please. And I won't read this whole slide. I'll let you read through it on your own. But the market approach is typically the way you value a company whose stock is traded, whose ownership is held by numerous people and is traded. And it's a question of looking up similar companies and their market and seeing what they're worth. That very rarely applies in the security industry, except for maybe the very largest integrators and alarm companies. So let's look at the next slide. And that's the income approach. And that's pretty much what we'll be focusing on today for a systems integrator that doesn't have a large RMR component. And that value in the income approach can be determined by the present value of future benefits to be derived from the ownership of the assets or from the company. So it focuses on the entity's ability to generate future earnings or cash flows by considering the stream of benefits an investor or buyer expects to receive, the timing of the receipt of those benefits, because a dollar that you get today is worth a lot more than a dollar you get a year from now, the risk borne by the investor that the benefits won't materialize. So there's no sure thing when you're buying a company that you're going to get those cash flows. And this is the most common method used in the income approach are the capitalization and discount methods. And we'll talk about that a little bit later. Next slide. The asset approach, and that's what you're seeing when you see a typical company being valued based on RMR. The asset approach is based on the principle that the value of the entity can be determined by the value of its net assets. And so when you're doing a valuation of a company that's mainly RMR, you're looking at the value of that RMR, and then perhaps if you're selling the whole company, looking at the balance sheet and subtracting liabilities from assets and figuring out a value. We'll look at the next slide. And the asset approach for RMR sales, and that's something we're not necessarily talking about today, but the income approach is typically not applied, as the income approach assumes the company is going to continue on as a going concern. Typically when you're selling just RMR, the buyer knows what their costs are to accommodate and service that RMR, and they're just looking at the revenue stream and folding it into their business model. So that's why we use the asset approach for an RMR sale. Next slide. The first income approach we're going to look at is a capitalization of earnings cash flow method. And that is determining the entity's earning capacity based on reference to historical earnings or cash flow and adjustment if appropriate, and capitalizing this amount with the appropriate capitalization method. This is usually used to value an integrator who's reached a stable level of sales and expenses, and you can look at their historical cash flows, and they've got reliable financial statements, and you can work from those and figure out what their future cash flows ought to be. We can't always use this in the security industry because not a lot of companies have really reliable financial statements, and it's hard to figure out exactly what are the true costs of the company. And so let's look at the next slide. What you typically use to value an integrator is the discounted earnings or cash flow method. And the difference between this and the other method is that this is looking at operational factors, the amount of sales, typical cost of sales, operating expenses and overhead, and backing into what their financial information should be, estimating the cash flows, discounting the cash flows, and working from there. And what you usually see, especially in this market where systems integration is growing so fast, is a company that's growing extremely quickly and is having a hard time assessing their historical financial performance. And this is how we approach the valuation of a large systems integrator. So next slide. This is what we're really after today, is how do you value a pure systems integration company? So a mature company, you use a capitalization as of earnings or cash flow method, and you take the historical earnings and the net cash flow, prepare a pro forma income and cash flow estimate, and then we take the future cash flows and discount them back and arrive at a value for that company. It sounds pretty easy and it fits into 2 paragraphs, but there's an art to it, and it takes a lot of work to figure out exactly what you expect these cash flows to be. Next slide. A growing or dynamic company, and that's usually what you see in this industry, is a company that's got fast growth and is getting into new parts of the systems integration industry, or a company whose sales jump around and whose costs are not standard. We use the discounted earnings or cash flow method, and we look at the operational results. For example, what their sales are and what they're expected to be next year. They're expected maybe to get more into the video area, more into access control, or they've got some more government accounts coming online. So you take those operational activities and you run them out for 7 years or so, and you figure out what their expected sales are going to be. You match up what you expect the costs are going to be to that, and you arrive at an expected cash flow. You can compute that stream of cash flows. You just count them back and apply a risk factor to them, and that is how you come up with a valuation. Again, that's just a 2-paragraph explanation of something that's an art and takes quite a bit of time to do. But we understand the industry, and we understand what expectations should be, and that is the only way, I think, to value a fast-growing systems integration company. Next slide. How do you value a hybrid systems integration company? By a hybrid company, we mean it has a profitable systems integration component and a material piece of RMR. So you may have a company with $12 million of systems integration sales and $200,000 of RMR. And so the first thing you do is use a steady state analysis. And what that is, you take the RMR and monitoring component and you figure what their RMR is, what it costs to monitor and service that RMR, and you strip all the other costs from the monitoring and alarm company side out of that to figure out what that cash flow is. And you come up with a value for that. Then the remaining operations, the pure systems integrations part of the company, are used valuing the income approach. And you take those 2 valuations and you add them together, and that determines your total value. And Kim, that is how we approach how we approach the valuation. But there are 2 things you have to consider when you're doing a valuation. And one is a discount for lack of control. And what that's saying is, if the person that is trying to figure out the valuation, maybe a 20% stockholder, doesn't control the company, is their value really 1/5 of what the total value of the company is? And we say no, because that minority shareholder can't necessarily control the operations of the company. They can't control management salaries, they can't control owner salaries, they can't control distributions, and they can't control a lot of parts of the operations. So their value may be strongly discounted. And when we run into that a lot of times is when there are partner disputes and minority partners looking for a value, you're allowed to apply a lack of control discount. And then there's also a lack of marketability discount. And that recognizes that the owner of a business interest cannot convert his or her interest into cash as easily and quickly as a shareholder in a publicly traded company. So what that's saying is that if I have a 20% ownership of a company and it's privately held, I can't sell as quickly as I could sell a bunch of shares of IBM stock. 1, because I can't cause the company to sell the asset, and 2, because if I sold that much of a company that small, it could depress the market. The other thing you're looking at, too, which differentiates a systems integration company from an RMR company, is it takes longer to sell a systems integration company because there's not a ready market like there is for RMR. So that's something you have to take into consideration when doing the value. And so, Ken, that's what we look at when we look at traditional systems integration company. Yes.
Can you hear me?
Yes.
You're running out of time, about 10 minutes.
Done.
And I just woke up, so I realized you're out of time. So this is very interesting if you have a CPA. But I think you said that there were 2 things that they need to consider. I have to tell you, after listening to you, there's really 4 things what they have to consider. And it's either your phone number or the 3 phone numbers of the other guys that are presenting. Because this stuff is really way ahead of what a business owner might need to know. let me ask you two questions before I let you go. And you got to be brief. What is the relief from royalties method of valuing an intangible asset?
When you have a company with a large name or a large intangible asset, for example, when we valued Sonatrol for the Aspire Capital purchase, you can figure out what that company name is worth by looking at what a franchisee would pay to use that name. And so,
well, I don't think Monotrol's listening. So why don't we pick an easier one? Why is a company with $1 million of free cash flow worth more than 10 times as much as a company with $100,000 free cash flow?
That's because there are more buyers for a larger company, and a company with that much cash flow.
Is that the answer? Uh-oh. Hello? I think we lost Mitch somewhere along the line, which we're going to be moving on to Ray anyway. Ray, are you there?
I am here.
Okay. And man, that was technical. So but we're going to put you on now, Ray, and I hope that you can follow up. And let me just get to your slides here. Okay.
There we are.
Raymond Lynn is another expert. And Ray, tell us about yourself, and then let's go.
Okay. If we can go to the next slide. This will tell you who I am. I've been in the industry for about 23 years. I've conducted over 300 financial reviews and over 200 transactions. What allows me to speak this way? Well, I do have a background in accounting. I have a degree. I have a CPA. I have 23 years of experience with large companies and on my own for the past 5 or 6 years. And my focus has been on the dealers, integrators, and fire companies in various capacities in the financial side and internal audit, M&A, due diligence, valuations, etc. So we go to the next slide. Oh, back up one. There we go. Who is Sandra Jones and Company? We're independent financial and strategic business development consultants. Since 1990, worked with systems integrators on transactions and ways to increase their cash flow and value. We tailor our services around your needs. We develop strategies that increase cash flows, profits, and valuations. We conduct financial reviews to ensure you're operating at peak performance. And we provide complete M&A services or just the aspects needed. Next. It's just our disclaimer up front. We can go on to the next one. So if we take a look at valuations between a systems integrator and an RMR companies, what are the differences? A system integrator is typically valued based on a multiple of their operating earnings, or it's typically called Ebitda, whereas the RMR company is valued based on a multiple of their recurring monthly revenue. So on the integration side, the ultimate goal is to maximize your profits, where on the RMR side, it's to maximize your RMR. Integrators strive for consistent revenue growth. RMR companies can strive for consistent RMR growth. And the big difference between the two is profit margins on new systems installations weigh real heavy on the integrator side. On the RMR side, it's not a major concern because a lot of times they sell new installations at a loss in order to gain the all-important RMR. We'll go to the next slide. So what is Ebitda, the thing that integrators are valued on? Ebitda stands for earnings before interest, income taxes, depreciation, and amortization. In layman's terms, it's operating profit. And typically you see this number adjusted for certain things to get the real value that the multiple is applied to. Most of it is stockholder related. So if you look at your operating profit, you need to add back or add to that, your excess stockholder compensation, benefits that are paid to the stockholders, certain expenses that the stockholder may run through the company, such as cars, memberships, etc. A lot of times the stockholder also owns the building, and in addition to rent, runs maintenance and repairs to the building through. And the other thing you need to consider is if you're taking the stockholder out and they were the main person running the business, you may need to replace those expenses with what a typical general manager would cost if they're replacing the stockholder and running the business. Next. So what's really happened to system integrator value over the past 5 years? We can go to the next slide. If total revenue is any indication, valuations have decreased. And this slide was prepared from looking at the SDM top integrators for the past 5 years. This is a combination of 44 integration companies who reported in each of the 5 years. And looking at this, basically the integration revenue from 2008, which is probably no surprise to any of you, has decreased down to and has not recovered yet back to 2012. If we go on to the next slide, if we look at the RMR side of the business, actual revenue has increased over that same period. If we look at the dark blue line versus the light blue line, which is the integration total revenue. If we go on to the next slide. So why were RMR companies able to consistently grow revenue? Next slide. The answer is recurring revenue. If we just look at the RMR component, recurring revenue component of the RMR businesses, their RMR grew on average of 7.9% during this period. If we go on to the next one.
Ray, this is a good time to plug my contracts, I think, isn't it?
If you want to. I mean, we have a message from our sponsor here, or?
I want you to, not me.
Oh, you want me to?
All right,
we'll get there. We'll get there. Keep going. Okay. Keep going. Okay, so if we remove the RMR component from the RMR total revenue and just look at their non-residential installation revenue, you can see the dark blue line almost mirrors the integrator line. So it's the RMR that has had a major impact on the valuation for the RMR side. Yep, you can go on to that slide. That's fine. So how can integrators build value? Next slide. Add recurring revenue. This slide actually shows an example of a company, actual company, who decided to add 2 RMR services. And if you take a look at the top line versus the bottom line, which is their value with the services and without the services, you can see by the end of the 5th year, their value of $9 million versus $5.8 million really increases with the RMR services added. And if you also notice that they actually, without the added services, began to lose value at the end of the 5th year. Next. The other thing to look at to increase your Ebitda is to review your sales compensation. Your sales compensation plans should be designed to drive sales of profitable revenue types. They should provide results in concert with your growth strategy, and they should not allow marginal sales representatives to hang on. We've seen several examples where management has decided that they want to start selling or entering into new ventures like video monitoring, things along those lines, and they can't understand why their sales reps aren't selling those. Well, it's because the sales compensation plan doesn't reward the salespeople for selling these, so they're going to sell what gets them the most money. Next slide. Also, you should do a profitability wellness check. And what does this mean? Well, you seek professional guidance from a doctor to gauge how your personal health and wellness is, but have you ever done anything like that for your company? Sorry, I had to click on something. I had an email pop in right in the middle of my slide here. So how well is your company's income statement? An independent check determines departmental profitability, and what I'm talking about there is typical income statements that I see just basically will list on the top, it'll say revenue, and then it'll say expenses. By installation or by departmental productivity, we're looking at the income and expense of each of the individual departments, seeing how the margins look at those and comparing those to industry averages, and which identifies certain things that where improvements can be made. Installation productivity, what I mean by that is how much of the time do your installers actually spend on the job versus downtime such as, vacation and sick time versus going to ADI to pick up parts, things along those lines. The other thing is the reasonableness of SG&A expenses. And all of this is an opportunity to make changes and increase your profits. So the next slide. Can Sandra Jones and Company help? Absolutely.
Ray?
Yes, sir.
Let me ask you a question before I let you go.
You
if
can
a
do
company doesn't plan on selling their company, should they spend any money on valuation to discover what that company's worth? Any reason to keep track of that?
There sure is. I mean, first of all, you should always know what the value of your company is. It's like getting your bank statement at the end of the month. You always want to make sure that, you know what's in the bank and what's there. And selling your company isn't the only reason to get a valuation. As Mitch pointed out some reasons, on his slides, and one he didn't point out, that you may not be wanting to sell, but you may need to seek financing. You may be entering a big project. You may be wanting to expand or do an acquisition to grow your business, and you need to get the money to be able to do that. And one bank is going to be looking for a valuation in order to be able to grant you the financing you need to do that.
Let me ask you this. Since we like to give away something at these webinars, how about one example of advice that you would give to increase the value or make a difference in profits to a company that we already consider is successful and profitable? Don't give away too much. They have to call you for the rest.
Well, I'll give an example of something we found on a company that was successful, and we were looking at it. They had several branches, and we were looking at their branch productivity, and we found in going through that their installers in one branch were only 47% productive. What that translates to is that their labor costs were actually double before applying any overhead to that. So that as soon as we pointed that out to them, there was a massive scrambling going on in the office, and they got to the bottom of it and got that fixed. And I just visited that client recently looking at their compensation plans, and lo and behold, guess what? Part of their compensation now is based on installation productivity.
Ray, thanks a lot. I want to thank you for participating. Ray doesn't have his phone number on this last slide, or his email address for that matter, but it is on the beginning of his slide. And there's a lot of information going on today, and this webinar is being recorded, and you will be able to listen to it again by calling Erica or Eileen, and they'll help you figure out how to log into this thing. So, Ray, I want to thank you, and we're going to move on now to our next presenter, always well received, our of counsel to my firm, Dennis Stern, well known to all of you. Dennis, are you there?
I'm here. Can you hear me?
We can hear you.
Okay. Well, it's a pleasure to be on the webinar. I'm a newcomer to the industry. I've been around for about 37 years and probably have done 500-plus transactions. So M&A, I enjoy it, and it's always challenging and different. In terms of this question of non-RMR assets of your security business, to me there are two aspects. One is the non-RMR assets of a traditional central station company, and the other one is the non-RMR assets when you're talking about a systems integration company. So if we go to the second slide as to the traditional central station company, the general view had been at one point in time, which has faded over a period of time, is that RMR was sort of like Ebitda, a rule of thumb by which to value when you're buying a complete entity, an ongoing alarm company with recurring monitoring. That's how you valued it, based on that multiple of RMR. That has changed, and so you have two different perspectives. A seller looks at it very differently than the buyer, and the seller looks at it, the RMR is for my accounts, for the contract, and then you got to pay me for certain other assets. The buyer, on the other hand, still tries to hold on to the concept that if I give you a multiple for the RMR, that includes the whole operation. Obviously, in dealer networks, that's very different because all they're buying is contracts. Here, if you're talking about a standalone alarm company that's being sold, people are looking for the entire company, including all of its assets. Having said that, there are certain items which have popped up over a period of time, which I've seen, where people ask for additional consideration aside from the RMR multiple, which is really relates to your monitoring contract. So contracted service, contracts for fire tests and inspections. That multiple, it depends. If you have a large book of monitoring RMR, somebody who will pay you a full multiple for that will probably, if the contracted service and fire test and inspection is a small piece of your business, probably apply that same multiple. So if they're paying you a 40 for the monitoring and you have a small piece, that's the other one, they'll probably continue with that. If, however, contracted service, fire test and inspection is a significant portion of your recurring, most buyers will try to segregate out what multiple they pay you for the monitoring versus contracted service and fire test and inspection. And the reason is pretty simple, namely that monitoring, whether it's done internally or through a third party, carries a very high margin. I mean, if you have your own monitoring center, you should be able to do 75, 85% of margins on that. Contracted service, fire test, and inspection don't have that kind of margin because there's a much higher labor content, so maybe they're in the 30, 40, 35 to 40% margin area. Therefore, they don't generally command the same kind of multiple. People have also raised issues about what about my non-contracted, T&M, time and material billings. I've owned this company for 10 years. I can show you for the last 6 years, 5 years, whatever it is. Every month I have 10,000 of T&M billings, and that has a value to it. So why shouldn't I get paid for that, as opposed to saying that 10,000 is somehow included in the monitoring RMR that you're paying me for? And that's a very good question. There aren't many buyers that I know who will actually assign a value to that. If they do, again, because it's non-contracted, but to me, if you can show a consistency over, let's say, 36 months, that sounds like something that would continue, whether it's contracted or not. But the multiples you're looking at for that is more like, the 10, 12, 13 multiple range. Now, alternatively, one can also make the argument, well, maybe you can't pay me for it, but at least it should be an offset to what you do in terms of the reductions for cancellations on the account guarantee. Because, again, that stream of revenue, which has been there for 36 months, is going to have a value to you. So if you're going to deduct for cancellations, which we all know any company, no matter how good, is going to have cancellations, maybe I can get some credit on that side against cancellations. When you get into all of these asset issues, it's always a question of negotiation. I mean, the no, as I think Mitch mentioned, the no rules, firm rules and regulations on all of this. Service and installation vehicles sometimes become an issue. The question is, if a company is very good at maintaining these vehicles and maybe they have very high mileage, which then obviously reduces their value to somebody who's buying the company. They then expect that that's part of what they're paying the RMR for. A lot of companies don't give vehicles to supervisory and sales personnel, so that can become an issue. Certainly service and installation vehicles, easy to value, go to your Blue Book. Then you get into questions, well, what about all the racks? And what about all the service inventory on the vehicles? And other issues as to valuation, especially if they're financed, who's going to pick up the financing costs? And generally, if you're going to ask for a Blue Book value, you would have to deliver clean title, means you have to pay that. The more problematic issue arises when it's under release, because many leasing companies don't allow vehicles to be transferred. Then you have a little challenge as to how you get them over to the buying side and how mechanically that all works. Inventory, another issue that gets raised. Lots of people still have no value inventory, which is inventory that they have when a system is terminated and it's company-owned equipment. They go out and they bring that equipment back. They use it for repairs down the road. But as it says, it's no value on their books, so people are not going to pay for that. But the real question is new inventory. Number one, is it in boxes? Number two, is it something that the company really has used in the last year, or is it something they bought 5 years ago and have never really used and now want to pass it on? So as a buyer, I want to know it's new, it's in boxes, and it has been used in the business in the past year. Then you get into questions of valuation. Is it what you, the seller, paid for it? Is it less than that because you want to take out taxes and shipping costs, so you want to get down to what the product itself costs? Those are issues, again, for negotiations. Accounts receivable, a lot of ways to deal with that. Some people want to get paid for those up front. If there's an agreement on that, they have to be discounted for two reasons. One, you have to have a bad debt reserve against the amount of the receivables, which should be based on the company's historical bad debt write-offs, and also a discount, 5, 10%, something like that, for the collection effort and the collectability risk. Most deals I've seen, it's usually you take the accounts receivable and you offset it against the deferred. Those tend to have a pretty good correlation, and it's the easiest way from an accounting perspective to deal with it. The other one is where the accounts receivable are left with the seller to collect. The issues there, it seems to me, is I just bought those accounts. Now you, the seller, who has no interest in those accounts other than to collect the receivables, is in control of that. That, to me, is not ideal, because the seller, who no longer owns the account, doesn't really have quite the care about the account the way you, the new owner, does, and can take a very hard line with the account debtor, and possibly collect his money but lose you an account in the process. And obviously, I realize, depending when that happens, there is a cancellation guarantee in most cases. So that cuts into that somewhat. You get requests for work in process, very tough issue. The easiest part of it is, if it's raised, is yes, if you have installation costs that are embedded and you're looking to get those back, less any prepayments maybe or down payments on the installation, that's one thing. If you're looking to share in the profitability of a job once it's completed after the company is sold, that raises a lot of very tough issues as to how you calculate all of that, and you probably need to hire Mitch and Ray to work that all out for you. Executed sales contracts, some people think they should get paid for that as well. Most buyers will view that as all being in the pipeline, and therefore that's what they're paying that overall multiple for. Furniture, fixtures, computers, unless it's very unique, nobody's going to pay for that. So these are all of the kind of creative things people have come up with in addition to RMR when they view the RMR as being purely for the contract. The bottom line is it's all a part of the negotiation. If you're getting a high multiple, the less likely a buyer is to concede any of these other points. If you're getting a low multiple for various reasons, they may very well give you some additional consideration through, through adding some of these items. So basically, bottom line is RMR is really a shorthand way to value your entire business. At least it gives you a pretty good indication when you look at that versus where the market is in terms of what you've got. It then fluctuates. How good is your company? What's your attrition rate? And all of those items factor in. Quickly on the systems integration side, very different there. I think as has been mentioned, the Ebitda is really the driving kind of factor in determining market value, however you want to slice what market value may be. People look at it on that basis. One of the reasons systems integration businesses are harder to sell is also, you got to remember, senior lenders still view that business as not being recurring, even though many integrators have had the same customer year after year, and they give them more business because they expand their business or because they need moves or other things. But the banks don't view that the same way as having a 3 or 5 year contract on the RMR. So people who want to buy a systems integrator run into the problem that senior lenders are not willing to fund those acquisitions the way they are on the RMR side. Having said that, it's still based on the Ebitda, and I'll tell you, even on the RMR valuations in this day and age, with the right buyer, by that I mean if it's an equity player who's looking to get into the market, you may be talking about RMR. They will take that and ultimately run the exercise to convert it to Ebitda to see what their payout is going to be, how long it's going to take them to recoup their investment. So it's not quite so clear-cut that, one type of business is RMR valued and the other one is Ebitda. But clearly the preponderance on integration, if not the sole valuing basis, is Ebitda. And the range is usually between, a 4 and a 7. The higher ones are obviously for the better companies, better managed, better customer base, longevity, name in the marketplace. It has some other unique features. Maybe it has some unique market niches and all of that. On the Ebitda side, you have to remember, it was mentioned earlier, the buyer is going to look at the adjusted, or the seller is going to propound the adjusted Ebitda, namely adding back things, expenses that are not going to be there because the owners no longer are there. And that's true up to a point, but you also got to take that with a grain of salt, because the buyer is part of the reason he can buy the company is because he's going to get some synergies and he's going to get some savings, which is going to increase the cash flow. So if you have Ebitda savings of $5 million or something like that, he is not going to base his valuation on $5 million of savings, because he wants part of those synergies for himself so that he can justify what he's paying for it. So when he looks at it, he's not going to give you $5 million. He's not going to accept the $5 million on the adjusted Ebitda. He may only give you about $2 million for that, saving the $3 million for himself, and so that he gets a kicker when he buys his operation. So, but it all gets back to Ebitda, either straightforward or adjusted or partially adjusted. When you get into, because systems integration businesses are starting more and more to get into the recurring business, which is a good thing. I know PSA has been pushing that for a long time. The fact is that that becomes a very tough kind of way to look at valuation, to have the Ebitda on the one side and the RMR on the other side. As one of the previous speakers mentioned, you got to completely peel out the RMR, because both on the revenue and the expense side, that impacts what your Ebitda is like. So if it's not much RMR, then it's maybe, it's really still valued purely on the Ebitda and maybe some additional consideration, which is hard to quantify, maybe ticks it up from a 5 to a 6 or a 6 to a 6.5, because people realize there's an additional value there. To do it as a kind of scientific approach gets to be very time-consuming, and if you have to hire, which most people do have to hire outside consultants to do that, it gets very, very tough.
Right,
so,
Dennis,
yep.
A little off topic. Let me ask you
sir.
something. A little off topic. Alarm companies are contracting, which they should be, for service. They need a contract for that, and for test and inspect. Would you value those a service contract, RMR, and a contract for test and inspect, RMR, or even if it's not RMR, T&M, would you value that differently than a monitoring contract? I mean, I know the answer, but why don't you spend...
Yeah, I mean, as I said before, I mean, those most... Depends, you know, if it's a small piece of your overall business, buyers may not. But, I mean, the general rule is it has less value because the margins are less. I mean, there's an active, you know, much higher labor component in those. So if you get on your contracted service or test and inspection, if you have a 35 to 40% margin, you're doing good. Monitoring, you should be getting a 75, 85% margin. So those are more valuable. And again, it depends how much of your business is tied up in that in terms of whether a buyer and how good a negotiator you have, whether the buyer is going to distinguish or say, well, I'll give you, you know, one rate overall. That also leads into some of the other issues. If I do that as a buyer, I may not be too sympathetic when you start raising issues about paying me for some of these other things I've gone over, you know. But clearly, though, that should be at a lower valuation than the monitoring from an economic perspective.
All right. Well, you gave away enough free information today.
But the other thing I didn't mention is that one of the most critical things is if you have good contracts on your RMR.
I should let you talk a little longer for that plug. Thanks. But
yeah, right. And the best one you can get is for Mr. Kirschenbaum. And I will tell you, in due diligence, if somebody sees it's his contract, you're not going to get any questions on it, you know, which is a very nice place to be. By the way, there were also 2 questions we got, and I guess you're telling me I'm out of time.
You're out of time. I got to move on to Barry.
Okay, I just want to tell those folks who send in their questions, I will respond to them offline.
Okay, thanks.
Okay, my pleasure. Take care, gentlemen. Bye.
Okay, thanks. And we're going to be moving on to Barry Epstein, always a favorite, and a great speaker, and a guy who really knows this stuff. Barry, are you there?
I am, Ken, thanks.
Okay, well, your first slide is up.
Okay, so for the next part, what we're going to talk about is how do you sell these non-recurring revenue-based companies? You know, it's when we trade in the companies that have either the PERS or the monitored alarm account companies, they trade at a multiple of RMR. It's a pretty narrow range. You know how they're going to do it. You know, 90% down, 10% holdback. There's a lot of factors that make it a pretty easy deal to get done. It's just the opposite on the non-recurring revenue-based companies. So Vertex Capital is our company. We're advisory services in the life safety sector. We represent sellers throughout the whole range, whether it's alarms, integrators, guards, fire companies, and medical alert, and buyers also. And we do them from all the way from the local guys all the way up to the public companies and the private equity-backed buyers. Next slide. So these are the 4 kind of groupings that you see that we represent to help sell them in the non-recurring revenue-based companies: the integrators, the fire companies, the fire sprinkler ones, and the access control and camera. Here, these are ones where their total revenue, the percentage of RMR is a small piece of their total revenue, and so they're really selling on a Ebitda or cash flow basis instead of some multiple of RMR. Next slide. Now, the two things you have to look at when you want to sell your company is the external market conditions and your company's specific conditions. With regard to the market in general, most of the buyers for these non-recurring revenue companies are either private equity companies or very large buyers. And the reason is they're the ones that have the money to do it. In an RMR, a guy that has 1,000 or 2,000 accounts, he can sell to someone that's equal to him in size. It doesn't happen in these non-recurring revenues. They generally can't get the bank financing, and they generally don't have the extra cash flow to do it. So you're really selling to a private equity company that's doing a roll-up, or you're selling to a large buyer that wants to incorporate you in because he wants a new market. The economic conditions matter a lot. As you saw from Ray's slide, in 08 and 09, there was very little selling in these non-recurring revenue companies because they didn't have any Ebitda. So when you multiply, 5 times 0, you still get 0. Now their Ebitda's up in the $1 million, $2 million mark. They're getting bigger and bigger because the economy's doing better. And so now there's a lot more transactions going on. And finally, the low interest rates make a difference because the buyers can borrow cheaply to fund their acquisitions. With regard to the company-specific conditions, it really is the 3 Ps, profitability, pipeline, and percentage. They're going to trade on a multiple of your profitability. So the more you've got, the more not only the more you've got, the more you'll sell for, but the more you've got, the more you can get a price that works for the seller that he will actually sell for. As far as the pipeline, the buyers look at this very heavily because they want to know they're buying a revenue stream, and they want to know that there's going to be a healthy stream going forward, and they're not buying something which the revenue drops by 50% a year after they buy it, and they're stuck with holding the bag. And the last one is the percentage of revenue of the largest customer. If your largest customer is 60% of your revenues, that's very tough to sell because if that guy goes away, again, you've lost half the revenue of your company. If it's more like 10 or 12%, it's a lot easier to sell, and there's a lot more buyers that will come to the table. Okay, next slide. So now we'll look at valuation. See how are they valuing them in today's marketplace? We're in the middle of a number of these transactions now, and they're all kind of based on a multiple of adjusted Ebitda. We saw earlier that Ebitda was defined. It's basically cash flow, but it's your earnings, and you put back in your interest, taxes, depreciation, amortization. That gives you the basic Ebitda. Most of these trade on adjusted Ebitda. And so to get adjusted Ebitda, you take that first number and you add in your personal add backs, all your perks that the owners are taking out that the new buyer wouldn't have to incur. You add that back in, and then you have to subtract out what it would cost a manager to replace the owner because somebody has to run it. It could either be the full cost of a new manager to come in from somewhere else, or the incremental amount that you might have to pay the sales manager to jump up to running it as a branch. But you take that out, and that's your adjusted Ebitda. In today's market, most of the deals we're seeing are going in the 4 to 6 times adjusted Ebitda. And the buyers, and we've heard throughout the first 3 speakers that recurring revenue matters. The recurring revenue matters because the buyers are looking for the sticky revenue. And if you've got $5 million in revenue annually, and $1 million of it annually is recurring revenue, even if it's service contracts, it's a less risky company than another company that has the same $5 million in revenue but has no recurring revenue. Because now every year they start at 0, and the first guy starts at $1 million in revenue. So there's less they have to make up if the vagaries of the economy go up and down. What's interesting is what we found is that the more recurring revenue you have doesn't translate to a higher price because, again, they're trading on a multiple of adjusted Ebitda. It translates to more buyers. We've represented sellers. We'll call some of the buyers, and they say, tell me the percentage that you have tell me the percentage of recurring revenue as a percentage of total revenue. And if we tell them, if it's in that 10 to 15% range or more, they want to see the deal. If it's 5%, they say pass and please send me the next deal. So it really does benefit you to get more buyers if you can get that recurring revenue up. Next slide. Now we come to the structure, and this again is very different. As we said in the alarm industry, you can get 85 or 90% down, and with the leftover, the 10 or 15% holdback, and those deals kind of click off one after the other. There's no easy formula for the non-recurring industry. A total walkaway is very rare. I haven't seen it in a lot of years. Most of the time, they're going to put more than half of it down, and the rest they're going to defer the payments in one of 3 ways. If they're concerned about whether the revenue and the income stream will stay, they'll give you a performance payout. So they might give you 70% down, and then 10% in each of the next 3 years if you get the same amount of revenue or the same amount of income, so that they're not holding an empty bag. The second one, which is less risky for the seller, is a multi-year note. Again, they might say 70% down and 10% for each of the 3 years, but it's not performance-based. So you're going to get it whether the company goes up or down. You're going to get it either way. And the third one is an equity piece that will pay off later when the private equity buys you 12 other guys, rolls it up into a $200 or $300 million company, and then flips it for a larger number. And if they want you to stay on, which a lot of the equity guys do because they need somebody to run these operations, they will want you to not only stay on, they'll want you to roll part of your purchase price, maybe 20% of your purchase price, into the equity, which makes you have skin in the game. They like it to where you need it to succeed as much as they need it to succeed. And while the downside is that equity could go to zero, the upside is it can go to a lot more than its present dollar amount. Next slide. So when you put all these things together, if you're selling your fire company or your guard company or your integration company, any of these non-recurring revenue companies, you really benefit from having sell-side representation. And the reason is that the buyer only is going to know a few people in his industry, whether it's local, maybe it's in the trade magazines or it's from the conferences. He's only going to know a few of the people that he can sell to. Whereas companies like ours or any of the ones that do what we do, we know the buyers all over the country. We know what they can do, and we know where they want to go into, what markets. So you might be in Florida, and it might be that you sell to a company in Illinois or California or Arizona because they've been wanting to get in the Florida market, and you could never know that unless you're doing it all the time. The auction process means that you'll get more buyers with different scenarios. Buyer one might give you more money but less up front, and the second one might give you less up front. He might give you more up front and less later, but he wants you to stay on. And the third one might want a performance payout, and the fourth one might want a note, so he has less risk. So if you are able to have someone that has experience weighing all these different scenarios, you'll end up with a lot better outcome than if you do it yourself and you're looking at one buyer. The other thing is that the people that do the sell-side representation, they know where these buyers can go. A buyer may tell you, I can't move on this term or this price or this structure. He can't say it to the representative that has seen him do beyond that in 2 or 3 transactions already. So you've got someone that can go deeper into the pockets, whether it's in price terms or structure. And in the end of the day, the best deal is the one that gets you the combination of all 3. It's not always the highest price. It really is the combination of some people who will take care of your employees the best, if that's important to you, how you get your payout, what do you want to do for tax reasons. There's a whole lot of things that go into the price terms and structure. Next slide. So the summary is that the number of deals that we're closing and working on right now and the sales prices we're getting are much more now than they were a couple of years ago, certainly much more than 08, 09 when there's basically no deals because nobody had any profitability to multiply anything by. So as the profitability increases for these companies, more deals get done at higher prices. Also, you've got private equities need to grow. They're taking in money from investors. They have to put it to use, or they've got to give it back. They've got to grow it, and they've got to flip it. So they need deals to get done, and a lot of them we know out there are behind in what they're looking for in their annual budget of what they wanted to buy for the year, and that makes them even hungrier to get the deals done. And finally, the cheap money to help fuel the growth. The banks won't lend to the small buyers, but they're lending with an open pocketbook to the larger buyers, whether they're private equity or large companies in general.
Barry, thank you. And one way to wrap up this webinar is let's take an example of a relatively successful company. So a prospective seller owns a security and fire integration company and wants to know a fair selling price. It has revenue of $12 million, Ebitda of $3 million, cash flow $2 million. What's a fair selling price? And by the way, just because I don't really get it, I understand what $12 million in revenue is. So just tell me very quickly how you get to $3 million in Ebitda and how you get the cash flow of $2 million, and then how you do your pricing, your valuation of that company.
So in general, to get to the $3 million of Ebitda, you're going to take, the net income. I'm going to assume it's adjusted Ebitda without.
Right.
I'd be happy to talk to whoever it was to narrow it down where they are. But in general, with response to this specific question, you're going to take the net income. You're going to add in you know, the depreciation, amortization, taxes and interest, all the perks, and then subtract out, he probably hasn't subtracted out, but you'll subtract out when a new manager would come in. Assuming he's at $3 million of Ebitda, and he's going to trade in the 4 to 6 times range, that's going to be in the $12 to $18 million range. Now, what's going to affect where he is in that range is a number of things, which would include the percentage of RMR, which again doesn't raise the price, but it brings more buyers because it has more sticky revenue. The commercial government mix. The location, is it a place where people want to be? Is it a place where somebody wants to move into? The customer density, what's the, you know, is somebody 60% or is their biggest customer 10% of their total revenue? When you add all that together, that's going to, and the last piece is how steady is that Ebitda? If you've been making $1 million for 3 years and now you jump to $3 million, they're going to take an average over the last 3 or 4 years.
What about cash flow? How do you get a $2 million cash flow when you have revenue of $12 million? What does cash flow mean?
You know, again, the cash flow is a definition that really has a whole. It's everyone uses it a different way. So I'd have to know how he uses it. Some people use it as Ebitda. Some people use it everyone uses it in a different way. So it's not an easy answer to give. But I think if he's going to trade off of his Ebitda at the end of the day. And so that's the multiple that he's going to get a multiple off of that base, and it's going to vary in that range based on all those factors that I just mentioned.
Do you know the term enterprise value?
Again, yes, there's an enterprise value, but again, if you looked it up, it's going to have a whole lot of different definitions. So it's easier for the sellers to stick to Ebitda and a multiple Ebitda because in all the deals we're doing, that's what all the buyers are talking to us on.
Okay, well, thank you. And I want to thank all of our presenters, and all of whom are obviously very expert in these valuation techniques and understand how all of this works. Certainly the tax background that they have, I'm sure help them out, and all the different deals that they do also help them out. I want to thank everyone for participating and listening and attending. And if anyone wants to hear the recording on this, they can get back to my office. Erica is extension 308. Eileen is extension 312. And they can help you figure out how to get to a recording of this webinar. So I want to thank you all for spending time with us. Oh, Eric is reminding me that I promised a discount when I first got started. Well, let's see. For those of you that want to hang around, let me see what we have. We have I'm going to have to do a whole webinar on this one. We have the a sales affiliate agreement that we've put together. This is a contract between an alarm company and an independent sales contractor. So I know there's been a lot of information on our daily emails that deal with hiring independent contractors and when they really are independent and not. And what this contract does, it sets out the relationship between the alarm company and an independent sales affiliate. This would be something that would be used instead of the employment contract that we sell, which obviously is an employee as opposed to an independent contractor. So we'll take $100 off the price of this one, and this contract refers to a business associate agreement, which requires that an independent contractor have a written policy which includes not only red flag rules, but a compliance with a bunch of other regulations as well. This was put together by our Labor Department. So things such as the False Claims Act and other things that need to be put into an agreement. It is basically a policy. And the sales associate agreement says that the sales associate, the affiliate rather, will have his own business associate agreement. So we'll take $100 off this one as well. And you can go online and just deduct $100 from the price that we have posted. I'm not really sure how much we charge. And as you all know, the contracts are located at an alarm contracts.com. So I want to thank you. Our next webinar is next week, also packed with real experts that know their topic. And we'll announce it in the emails. We've been announcing it. And again, thanks. Sorry that we ran over a little bit. And I hope you all have a great day.